Welcome everyone. Good morning, good afternoon, good evening. Welcome to this launch of our 2021 report on the future of cross-border payments. I'm John Orchard, OMFIF's CEO. Thank you for joining us today. You're in very good company. We've got an extraordinary global range of central banks registered today. We have payment companies, old and new. We have technology companies, parliamentarians, finance ministries. We've got regulators, commercial banks, asset managers, security services providers, multilateral development banks, academics, accountancy firms, deposit insurance agencies, journalists, and other think tanks. And thank you all very much for your interest. It's understandable that so many sectors and stakeholders would be interested, since the world of payments is in the middle of a transformation that goes all the way from the mechanics of contactless payments through to national sovereignty and geopolitics at the other end. At OMFIF's Digital Monetary Institute, we've been talking about CBDC for 2 years, more or less. And these conversations have been interesting and in many cases complex and challenging. And I'm sure we'll come back to that later, as well as the reasons why the conversation is necessary at all. Our remit today, though, is a bit wider than CBDC. And that's for two reasons. The first I've already touched on. Any conversation about CBDC quickly finds itself in adjacent areas: technology, regulation, identity, security, and financial stability, to mention the most obvious. The other reason is that the existing world of payments is already changing quickly around new standards and technologies. And that's one of the key findings that I've certainly taken away from our report, which my colleague Lewis McLennan will summarize for you briefly in a moment. And it may be, in fact, that the CBDC discussion itself is already achieving its aim of driving improvement in payment systems, much as central banks talking about monetary policy without necessarily changing it can move markets in the direction that they want. We'll look at cross-border payments, wholesale and retail. We'll look at the role central banks do or might or should play in those as the technology changes at speed. And those changes themselves bring questions about the global financial architecture, of course, but also questions about the relationship between technology and regulation. We'll look at cyber risk too. Joining me to talk about these themes is a very good cross-section of the stakeholders involved, who I'll introduce to you shortly. And before that, I'd like to invite you as the audience to vote in our poll. We're going to ask the same question at the end, once you've heard us tour around the issues I've just mentioned. The question is, should there be an evolution in cross-border payments or a revolution? So I'm going to give you a bit of help with definitions. It sounds like a simple question, but it's pretty complicated. So by revolution, we essentially mean putting the global money system on distributed ledger technology under some form of supranational governance and potentially enabling counterparties to transact directly across borders, perhaps without using commercial banks, using maybe regulated stablecoins, and assuming that KYC, AML, and capital control issues have all been solved for. So for our purposes today, that's revolution. If you think the risks of that outweigh the opportunities and that the existing architecture should be upgraded, possibly using versions of DLT in places, but also with the existing intermediaries, so commercial banks and payment and settlements platforms as they already exist, and the fee structures that go with them. So please then pick evolution. So if you could vote on that now. And then, Sasha, if you could pass me the result while I introduce the panelists, I'll share that with you, and then we'll ask again at the end. Before I do that, though, Lewis, please take us through a bit of a tour of what we've covered in the very detailed report. Over to you, Lewis.
Thanks, John, and thanks to everyone for joining the launch of our Future of Cross-Border Payments report. I'm Lewis McLennan, and I'm the editor of the Digital Monetary Institute at OMFIF. So yeah, as John said, I just wanted to take a few moments to run through some of the big takeaways from the report. cross-border payments are obviously a hugely important part of the world's financial architecture, and the volume's only increasing every year. EY puts it at 156 trillion next year, and they estimate that it's growing around 5% a year. But I think it's interesting to note how widely the statistics on this topic can vary. In the report, Mark McNulty, Citi's head of payments and receivables for EMEA, he said that the definition of wholesale payments is something of a moving target, but I would maybe expand that to say that in some ways you can say that for the whole field of cross-border payments. And the reason for that is actually quite instructive, I think, because it's the same reason that underpins some of the reasons that cross-border transactions are so much more difficult and less efficient than domestic payments. And that reason, and this comes out throughout the report, is that countries all over the world are using their own definitions and their own systems, which have been designed for national needs. These standards aren't harmonized across the market, and that makes even something as simple as evaluating, the scale of the market and its growth is complicated. And it's one of the reasons why the problems are difficult to pin down and quantify. BIS, their committee on payments and market infrastructure, they've done some excellent work on diagnosing these problems and setting targets for the solution, and really establishing a framework for the type of work that needs to be done to improve the sector. And that's covered in some detail. The problems in the wholesale payments architecture as it stands. That's covered in some detail in chapter 3 of the report. And this week I should mention that the BIS, I believe, has set up a task force to discuss new agreements and ensure that we're maintaining some consistency across the market. Finding that consistency, avoiding the mistakes that were made when building the payment networks that we rely on at the moment. That's another big key theme in the report. These payment systems, often they've been set up as walled gardens, so things work fine within the network. You can transfer pretty efficiently to people within your network, but exchanging between those networks is quite difficult and costly and inefficient. And there's a lot of solutions in development at the moment which are very exciting, and they're promising cheaper and quicker and accessible and transparent payment systems. But unless these projects, and many of them are working extremely hard on this, unless these projects are built from the start to be able to function harmoniously with other payment solutions, then we face being left in the same situation where we're scrambling to connect ecosystems that collect different data, store it in different formats, and don't work nicely together. And that's a big theme throughout the report. I think it comes into a few different chapters. The poll question that John has just given you, evolution or revolution. It's a really fascinating time just now, looking at the incumbents and the way they're adapting to improve standards, and then the way new players are entering the system. So chapters 1 and 2 of the report are really a really detailed look at how to evaluate those two things. So I think if that's a poll question that interests you, then these chapters will be a good way of getting a more detailed look at that. One of the really interesting consequences, I think, of some of the new harmonized data and CBDC architectures is that it opens up the possibility for a greater degree of scrutiny and transparency of the transactions that are going on than we can have at the moment. In some ways, that's obviously a good thing. It's more effective tools for combating fraud, money laundering, terrorist financing. But it could mean less privacy, and that's going to be a political decision. And there are technical solutions that can go some way towards protecting privacy and improving oversight. But I think it's important not to get away from the political implications of privacy, and that's something the world will have to come together to decide new rules on. So that's discussed. Chapter 4 on tokenization, and chapter 6 is a more detailed look at the cybersecurity implications. And then, just finally, I'd like to zoom in on the remittances market. It's much smaller than the wholesale and retail markets in terms of just the absolute scale. But if you consider the percentage of GDP that remittances make up of some small and emerging market countries, cost savings for remittances can have an absolutely huge effect on the economies of the recipient countries. This comes out in the report, but it's in chapter 5 in particular. But the remittances account for a larger amount of money than foreign direct investment and overseas development assistance combined. So although it's the numbers aren't quite so big, but it's still a really huge a topic of great importance, and chapter 5 is where that's covered. So I think that's enough from me. I'll hand back to John and the rest of the panel. But yeah, thanks very much for joining, and I hope you enjoy the panel and check out the report. Thanks very much.
Thank you, Lewis, very much. Sash, perhaps you can come and plug the camera back in. It's unplugged. Hopefully you can all hear me. Bear with me anyway. So let me just introduce the panel, who, as I say, represent a very good cross-section of the stakeholders that Lewis and I have already talked about. Thank you. We have Henry Holden, who's advisor at the BIS Innovation Hub. Lewis just mentioned them, an important paper out last week, and we'll come back to that. We have Saskia de Volder, Strategic Program Director at SWIFT. Hello, Saskia. We have Andrea Civelli, Senior Economist at Algorand, an Associate Professor in Economics at the University of Arkansas. We have Phantom, who is CEO of MetaMui, and you'll discover what that is in a little while. An interesting thing to explore. We have Rajiv Garodia, who's Global Head of Visa Government Solutions at Visa, and we have Dr. Joshua Daniel from JP Morgan, and he is Product Manager Coin Systems Onyx by JP Morgan, and we'll hear more about that. That's a very interesting project. So welcome to all of you, and thank you as well for supporting the creation of this important report. We appreciate it very much. So welcome everyone. A moment ago, I bought this in Starbucks via contactless payment on my mobile phone. The transaction involved Google Pay, plugged into a MasterCard debit card issued by HSBC. And that combination of factors is fairly recent, brought about by private sector actors, needless to say. And as an aside, the state played a big theoretical role in that transaction, but a very small practical role at the same time. So the transaction did involve physical money made by the state, which it probably would have done 10 years ago. That is causing some central banks to scratch their heads and worry. If I were in debt, the transaction would be using money that the Bank of England lets HSBC create within prescribed ratios. The state has to check that the participants don't create a cartel, of course, and it has to enforce interoperability standards. And it has to make me reasonably sure that HSBC can survive recessions and terrible markets. And it has to arrange for me to be paid back some savings in the unlikely event it did go bust. But I'm not transacting with the state or via the state for the specific transaction. Lots of the CBDC discussions lead to us to potentially change that. I want to explore that. The transaction fees weren't directly visible to me, and they don't seem to be prohibitive to the counterparties. So all of that's true for me to buy a chai latte in Starbucks. Quite a complicated process for something costing about £3. It's a bit different though if I go overseas. I mean, there's quite a lot going on there in principle and practice, and all seems to work. Albeit I need a bank account for it, and of course not everybody has one of those, and they're harder to come by for many people in many places. If I had flown to Frankfurt, say, and bought the same thing at the Starbucks in Goethestrasse, let's say, I would probably pay the same amount in transaction charges as the item, I think, if I'd used a bank card. The system in the background, of course, is working between currencies, between banking and regulatory jurisdictions. different tech platforms, potentially different languages. And Lewis has already touched on that and whether we can tidy all of that up in a payments revolution, and we'll come on to that. If I wanted to send money, so just remit cash rather than buy anything, and not to a merchant, to another financial counterparty, and I wanted to do that to a sub-Saharan African country, I'd pay a little over 8% for the privilege, as our report points out. So you could argue the people who typically do that most can probably least afford it. And that certainly has the eyes of regulators and think tanks. The payment revolutionaries are offering to make this quicker and cheaper, but the architecture I just described reminds us how much is going on behind the scenes. And this is what we're all trying to reconcile. The FSB has just written a report about how to improve all of this from the consumer perspective, and BIS, of course, has written a paper about it last week. So let's explore then, to start, what problems, if any, need solving in the existing cross-border payment system, wholesale and retail. And Henry, I think we'll start with you. Your unit, as we mentioned, put out a paper last week. What's the BIS view? And then we'll go around to the other institutions here. Over to you, Henry.
So we've been writing about this for quite a long time in the BIS. So it's nice. So thank you, Lewis, for mentioning the CPMI. Give me 30 seconds for an anecdote. So back in 2017, we wrote cross-border retail payments. There was a report out that came out in 2018. And it was me in Washington with about 4 other people from central banks, and we're writing this report, and nobody really cared about it enormously. And I was in Washington because I was at another meeting which was all about OTC derivatives, which was in a massive room in the CFTC, nearly 100 people. So and now I would say the interest is completely skewed. Now cross-border is hugely on the agenda, which I think is right. You know, you talked about remittances. It really makes a huge difference to people's lives. But it's no less complicated than OTC derivatives. The transaction that you just explained, that's just a sort of a taste of the difficulty. And with remittances, you get all the difficulties of cross-border and the inherent difficulties, plus all the difficulties potentially with financial inclusion, and then they multiply. It's horrible. So at least when it comes to cross-border, you have this sort of weird dichotomy of correspondent banking. Some people saying that this is not the sort of the right fit, and so and various companies trying to come up with alternatives, but simultaneously saying that there's de-risking, so there's not enough correspondent banking. And so it's like the Woody Allen joke. It's like, yeah, there's not enough of it, and it's rubbish. Which one is it? And then with financial inclusion, it's so difficult, so thorny. There's so many sort of idiosyncratic features, not just within a country, potentially just in a region, when it comes to sort of solving or alleviating some of these issues, and really. I'd say the World Bank publishes sort of remittance prices. I don't know if this is something you mentioned in your report, but they have this SMART metric. So yes, there's sort of averages that you can see, and it's far too expensive to send remittances home. But underneath the sort of the expense, the thing that really drives prices up from some countries, at least, some of this analysis shows, is there's just not enough choice and competition, either in the front end, so that's the sort of the people offering the services to end consumers, or in the back end, the sort of the means by which those sort of payment service providers can transfer money from one country to the other. So it's very, very difficult.
And we'll explore what the answers might be. As we go, I'm going to zigzag between retail and wholesale for the existing infrastructure. I think both are interesting and important for obvious reasons. Flipping back to, in particular, wholesale, Saskia, your organization is a key part of the existing infrastructure. Our report talks a lot about the work already in train. I have to say I didn't realise quite how much it was after all these sessions we've done on CBDC. You're working on a thing called ISO 20022. Tell us about that and what else Swift has been working on to address the existing infrastructure, please.
Okay, thank you, John. Indeed, Swift is at the heart of the correspondent banking today, and we transport more than $400 billion per day today. And I recognize some of the issues mentioned earlier, and the speed, the cost, the transparency of costs to the people involved in cross-border payments. We recognize those, and indeed, what are the big question is, what are the reasons, and are they to be, but by what can those be solved? And different reasons, indeed, you mentioned ISO 20022, the standard. There are too many languages out there, and we all speak English at the moment to understand each other. I think if we would all speak our own language, for me, Dutch, I don't think many people would get to me. So we need to agree on a common language. And the world is moving to ISO 20022. But of course, that takes a bit of time before everybody has adopted the full ISO 20022. So common language, standardized language. But other issues are as well, I think it was referred earlier by your colleague, is regulation. Every country has its own regulation. Some countries have currency controls. So all of those influence as well the fact that transactions go fast. And because Swift monitors transactions end to end through our GPI tracker, we can actually say that today, 56% of those GPI transactions are actually settled in 30 minutes. But there's still room for improvement, sure. But if we look at what are the reasons for those other percentages not to arrive, it's indeed currency controls, definitely, but also operating hours. We see that the delay is mainly at the receiving side. So the bank is not open because you go to a different time zone. The market infrastructure is potentially not available to guarantee settlement, which I think everybody wants, is finality. So the question is not only about technology, it's also about, regulation, harmonization, operating hours. And I think a lot of, I heard Henry just before, a lot of that was referred to in the CPMI work indeed.
Thank you, Saskia. That immediately brings up interesting issues about whether completely changing the system would be the easier way of getting around all those impediments, or whether that will be prevented because the regulation can't be made to match. And that's something we talk about a lot. We'll come back to that. Rajiv, I mentioned remittances, and so did Henry already. Your colleague Chad Harper writes about them in our report. Important area. It's the thing that could be improved that perhaps impacts the greatest number of people for the greatest benefit, maybe. Tell us what the challenges and opportunities are in this area. You mentioned in the report that there are something like 28 countries with up to 10% of GDP in remittances. It's pretty major, often for places that aren't particularly wealthy. So tell us what's going on in remittances to improve that situation.
Yeah, no, thank you, John. I'll build off of Saskia and Henry. But just to start with what you started with, which was your Starbucks example, I think it was a great experience you described. Your choice of brand was a bit unfortunate, but we can come back to this later. But I think your example kind of is the first point I would like to make around remittances. And I'll pick three themes here. One is common to what Saskia said, but two others might be slightly new. One is the whole digital experience of remittances, kind of similar to what you described for consumer payments. The customer expectations are getting very similar when it comes to cross-border payments. And it's almost like the e-commerce moment, like with COVID came a huge growth in e-commerce and a shift from retail to digital. I think something similar is happening to remittances. And this digital enablement is important for a few different reasons. So one is, of course, the customer experience is better. They can compare prices better. They can make choices on how they want to remit into a bank account, into cash. So that's a pretty important piece of how remittances evolve and the cross-border part of it evolve. But also there's a cost side of it, which comes with digital enablement, which is less discussed. And with digital enablement comes lower costs because there's a higher chance of customer being able to compare and contrast. And a big cost driver on top of factors which Henry pointed out is the cost of physical transactions. When it comes to cash being paid out or cash being paid in, that in our estimate is about 100 to 300 basis points cost of a transaction. And once these transactions move digital, there is a chance to reduce that. We're seeing a large growth in digital enablement on the sending side. However, we still feel on the receive side, which is the receiving side of the market, is where even if the transaction starts the journey of the digital transaction, it ends up in a physical cash transaction. And that's where the costs and inconvenience and all those factors come in. And this is where I think the governments could play a stronger role in this means people having bank accounts, people having access to wallets and things like that. But it doesn't necessarily stop with that. Just having an account on the other side does not lead to these transactions becoming digital. It needs an ecosystem around it. So if I'm receiving money in a financial account, I should be able to spend it at a merchant. I should be able to pay bills. And if those experiences are not digital, you can't have a remittance going end-to-end digital. So I think that on the first point around digital part of it, which applies to wholesale as well to an extent, but for remittances, it becomes quite important as to how the transition happens.
You don't necessarily mean a bank account. You mean some other form of payment system.
So if you think about what we do on the cross-border money movement side with products like Visa Direct, so we have like 5 billion accounts connected into our system where we go across card rails, ACH, RTPs, all of that. And that includes cards, that includes wallets, that includes bank accounts. So that form factor is important, but that's for customer to decide. But the form factor also determines how that money gets used from there.
Right.
And there should be a convenience around that. That's the part around the end-to-end enablement. The second point, I mean, Saskia brought it up very clearly, I think, which is a friction, is when money moves across borders, different regulatory regimes, money controls, and that drives friction, but also drives cost of compliance, and there's a cost of transaction, which is something to be looked at. And the third one is slightly connected to the theme today. We are seeing an explosion in different payment systems, which is a good thing. We have the traditional ACH, we have the correspondent banking, we have new RTP systems, we have the card rails. And I think the discussion should be also about how we make them interoperable. And how do you give then customer and the ecosystem the choice to use one system versus the other? And I think the world is not fully harmonized, but I still think some of the work which some companies are doing, including us, is how do you use these different systems and connect to each other so that then customer makes the final choice through a single point connection as to which channel they want to use. So I think this interoperability is a fairly important point from our perspective.
And Raj, we'll spend some time on that.
Yeah.
Most of what you've described is actually a challenge for regulators, really. It's for institutions in Henry's network rather than commercial organizations or technologists, I would argue. We can debate that. I want to come to the innovators and revolutionaries in a moment, but I want to first go to JP Morgan. It straddles many of these things in one go. It moves money retail, it moves it wholesale. It's been involved in a we're not going to talk about CBDC yet, Josh, it's not allowed, we'll come on to that, but you've been involved in an interesting CBDC experiment. Tell us, from your point of view as an important incumbent that already moves money from one end of the world to the other, what you think is could be improved about the existing system that you're an important part of?
Right, John, it is quite an exciting space. I mean, it is evolving and revolutionizing itself, as you described, and in terms of the value transfer, I think there are a lot of challenges that we're looking to solve, and some of them are trying to make payments 24/7, real time, and you touched on cross-border, cross-currency. I think if we can solve all of that and bring into reality, that'd be incredible. And I presume I can't speak yet about the CBDC, but in essence,
but well, I promise you will come to it. But yeah,
precisely. But in essence, be it commercial bank networks or M0, M1 networks, I think that interoperability is the key. And in the retail space, we've seen the national infrastructures have improved by leaps and bounds, but the lack of interoperability means we're still reliant on the correspondent banking network. So that leads us to having these long chains. So that's something we could solve for and reduce a lot of the frictions, reduce the payment chain lengths, improve interoperability in data standards, as mentioned by some of the panelists, and cutoff times, synchronizing these. I think that would make us move a long way.
Okay, thank you, Josh. There's still regulatory and oversight issues to solve for in the new architecture you propose, and we'll come on to that. I'd like to go over to Algorand. Andrea, briefly describe Algorand for the members of our audience who don't know what it does, and then let me know your view. Algorand has, in some sense, got quite radical proposals for changing the financial system and making it more efficient, in your view. But tell us about both of those things, please, Andrea.
Thank you, John. Algorand is a blockchain technology next generation company that produce infrastructure, blockchain infrastructure, and he has a very highly performant type of system that guarantees finality, high performance, rapidity, finality in the transactions. It doesn't fork. It's a blockchain that doesn't fork. It's based on a pure proof of stake consensus algorithm. So it's different from maybe the more known technology based on proof of work. This allows you to have a very high TPS and finalities in particular, because it is not is able to guarantee the fact that the blockchain doesn't fork, guarantees security and immutability of the payments and transaction systems. Is founded by Silvio Micali. Is an important cryptographer and computer scientist that and is a company based in Boston, and he's been funded the blockchain was launched in 2019, so it's been around for a few years. It's already creating a very large and robust ecosystem. They include for sure as you mentioned financial companies, financial initiatives, and so the future of finance type of highly scalable applications, but it also has a very rich ecosystem that encompasses many other activities, going from trading of carbon footprint rights to other initiatives in many other sectors of the economy and financial system. In terms of what we are discussing today, I think the common thread that have been saw in all these interventions so far, I think it can be summarized with the idea of uncertainty. There is uncertainty in these cross payment, cross currency transactions that comes from many sources, as we mentioned. It can come from regulatory aspects. It can come from a correspondent banking system. But fundamentally, if we think of this from the perspective of the technical, technology side, I think the main uncertainty probably comes from the fact that we have systems that favor somehow the creation of a closed loop payment system, or we like to call them walled gardens type of ecosystems. And this it multiplies and increases the Fed increases the difficulties and the cost of jumping from one of these ecosystem to another. We mentioned interoperability. You said we are coming back to that in a second. But if I may mention a couple of things about interoperability, which is probably the biggest issue at this point that people working in the DLT blockchain decentralized field are facing. reaching or achieving levels of interoperability across different blockchains at different standards is going to be the biggest challenge, not only for cross-country and cross-border payments, but for many other applications in the more.
Andrea, do you mean technically or in a regulatory sense? Or both?
Both of them. There are other panelists here that are better endowed than me to speak about regulatory constraints and and difficulties. But even from the technology perspective, allowing a slow or inefficient system to speak to faster or more final system is going to be a challenge that has to be faced and solved. In Algorand, we do have ideas, we do have approaches to do that. We can talk about token bridges, decentralized token bridges. We can talk about something that in Algorand we define co-chains, which is a way to guarantee interoperability across similar DLT systems. And I would be happy to do that. Maybe we do. I stop here for now, and
thank you, Andrea. We'll explore DLT again. Often the CBDC discussion ends up there, but it doesn't have to. Phantom, you're innovating here as well. One of the problems that occurs over and over again in our sessions, whether on CBDC or not, is the issue of trying to reconcile DeFi with the centralization implicit in regulation and supervision. Do you want to talk a little bit about what you do and how you attempt to resolve that? And then we'll move on into CBDC after that. Over to you, Phantom.
Thank you, John. And I'm working on an identity-based blockchain called MetaMui. And so basically, when you heard about identity-based blockchain, meaning that we can satisfy the regulatory framework. This is a very different innovation compared to current anonymous blockchain. The cryptocurrency originated anonymous token blockchain is very different than this financial specific blockchain that designed for it. So we can satisfy, we can implement all this kind of DeFi and all the cryptocurrency and other innovation that is and change that into identity-based system so that now the government and other financial banking system can use it, because we cannot use the anonymous token blockchain that basically allow money laundering or all these kind of problems into the financial system. So we can completely change those kind of approach and start innovating things. And one other thing in implementing cross-border payment, and one approach I'd like to emphasize is using the internet. If you think about financial inclusion and everything, that if you're going to wait until all the things evolve and then include everybody, I think it'll take a lot of time. So whether we can have disruptive innovation approach, internet is the most penetrated network. And if you have digital payment and digital currency system on top of it, they can satisfy the regulatory framework while providing the privacy. Then we can implement cross-border payment. And also many panelists mentioned about the compatibility issue. So internet is based on the standard and protocol approach. Instead of having very separate incompatible system and try to integrate one by one, if you have a similar approach, like internet has been built in the financial system using the DLT technology, new blockchain technology that is identity-based, then we can implement cross-border payment that can cover all around the globe, and then we can penetrate very fast.
Okay, well, that maybe helps, or systems like that help solve what Rajiv was talking about. It's potentially intriguing. We'll come back to cybersecurity later. We know central banks are pretty cautious about the cybersecurity risk, not only of existing technology, but particularly new technology, but that maybe can be reconciled. Henry, I've had an audience question already that I'd like to put to you first. If others of you would like to comment on it, put your hand up. If not, we'll move on after that. The questioner asks, non-banks are taking a share of smaller transfers. Cross-border airtime top-up transfers are also growing fast, substituting smaller remittances by MNOs. Is any views? Do we think this is good?
It's great. So the sort of the issue around sort of a lack of choice and competition drives innovation. And when you think about some of the sort of non-financial players, so for example, people like TransferWise or whatever they've renamed themselves to, they cater for a particular segment of cross-border payments. You know, so what's their business model? They net payments together, and so then they can reduce the transaction fees. That works very well for some people. I think the difficulty is we talk about cross-border payments. We imagine them as some sort of amorphous blob, or that they're all very similar. You know, you're paying for a coffee in Frankfurt is very different from I don't know, a treasurer trying to organize sending money to buy an airplane. And then the countries are very different as well. So the more options and the more choice we have, the better the result. But just one aspect on that occurred to me as Rajiv was speaking, actually, was sort of the choice and the competition is not always at the end user level when it comes to retail. You know, for example, did you care that you used MasterCard or Visa? No. No, and I don't care either. Nobody on this panel cares. But your bank did, HSBC, and so and it's at that level that sort of the choice and the competition for the kind of the back end needs to be. It needs to be at every layer of intermediation. You need a certain amount of choice and a certain amount of competition, because I can have 100 different options for a payment service provider, but if they all have to use one particular network, well, then the price will be the same. It's very difficult to differentiate.
I'll come back to just a second, Fanta. One quick supplementary question, Henry. So you're enthusiastic for a proliferation of service providers and a degree of competition. With non-banks and small payments, do you think they would need to be subject to the same regulatory standards as banks are? I mean, one of the things that we're paying for in all those transaction fees is the fact that banks are helping protect the regulatory environment. Do you think we could tolerate a smaller degree of KYC and so forth for the kind of remittances we've just been talking about in order to enable a greater number of people to compete? What do you think?
I mean, it's a personal view, but no. I think it should be exactly the same level, exactly the same requirement. And the reason I think that is because it forces innovation in that too. You know, if you look at some of the fintech companies, they meet exactly the same requirement as the banks, but they use technology to make that far more convenient. Actually, if you look at some, so again, this is anecdotal and it's stereotypical. But if you look at some of the requirements that are put on you by a traditional bank to meet KYC or AML requirements, you think that's really weird. Surely that can't be the actual law, and it's not. The law is actually quite sensible in a lot of the cases. It's just the implementation is mad. And fintech providers, to give them their due, they can do a much better job sometimes of implementing those conveniently, but with just as much sort of safety, but with a lot more efficiency.
Okay, so a useful competition, I think we're saying. Phantom, you had your hand up too. Phil, feel free to fire away briefly.
Yeah, so I'd like to mention about, I'd like to see this competition as in the point of view of automation. So Sasha mentioned about opening hours, and what this means is human is doing the processing. But if you can use the software and then automate things, then this kind of micro payment and small payment can be cost efficiently handled. And so we can reduce the transaction cost, sort of, and we can have a 24 hours, similar to ATM kind of machine. And if you have an ATM kind of system, for the cross-border payment and that competition is happening, then it'll reduce the cost a lot. And another point of view is in the future, we are seeing the world of IoT and metaverse and things like that. So not just human is paying the payment and sending the money. In the future, machine will do the transaction. Machine-to-machine commerce will require millions of transactions per second to cover this kind of commerce. But right now, no payment technology and even DLT technology cannot cover this. So we need innovative work to do that.
Several of you like to come in, and please do. So I just have a quick question. I'm going to come to you in a moment, Henry and Saskia. Just quickly over to you, Rajiv, on applying DLT to improve payments. Do you think that if you add DLT but keep broadly the existing infrastructure, that transaction, including through you, that transaction costs would go down? Assuming the regulatory issues have been solved, and I know that's tricky.
So I think we look at things in two different ways. A, we believe in interoperability, so the more systems there are, and our job is to thread them together. It always leads to better outcomes in terms of choices. We also think when it comes to any payment system, there are three layers of it. So, right, so the base layer is where regulators should pay a lot of attention, is around things like resilience, things like cybersecurity.
Yeah.
And those are very important part of the discussion of any technology you use. So that's super important. Like we run Visa at 6 nines, right? Which means our downtime is 23 seconds a year, right? You need to care about those things if you want to run a robust cross-border system. We have thousands of people who look at cybersecurity and fraud, and these are basics, but these sometimes need to be mentioned again because that's at the foundation of any payment system. And that applies to DLT as well. We need to test out how these things work. And then you have, on top of that base, then you have these open systems, and then on top of that, you build the use cases. We almost see it like a 3-layered cake. For example, we introduced USDC in Visa Network very recently, and we'll start testing it soon. So USDC are stable coins, and we have built our settlement systems in a way that we can now start incorporating stable coin like we do any other currency for settlement. And we looked at all those aspects there in terms of resilience, in terms of stability of value for the customers, and all those things we would with any other currency form factor. So we are already doing it, and that's coming to market soon.
Okay. Do you think DLT could make the regulatory costs cheaper, I suppose, is what I'm asking?
I don't know. It will depend on cost is driven by a whole bunch of different factors. Technology is just one part of it. And I think without looking at the end-to-end picture, it's very difficult to say.
Okay, thanks. Henry, you had your hand up then to Saskia, and then we'll go over to Andrea as well. So Henry, back to you, please.
No, so I was going to reply on something else, but actually, I was listening to the conversation. I was sort of struck by the number of people talking about interoperability, and I wasn't totally sure that everybody meant the same thing necessarily. So I get what Saskia is talking about because I'm familiar with ISO 20022, and it's just sort of open standards. But I wasn't necessarily sure if Rajiv and Josh were were talking about the same sort of stuff, because you're not going to build Visa on ISO 20022, and you're not necessarily going to have the same sort of standards for any of those sort of different aspects when it comes to the different systems. So was there something else? I was just curious.
Saskia, over to you.
Yes. Henry, first of all, great point. And I wanted to talk as well about interoperability and also replying to Phantom, what he mentioned earlier. On interoperability, my definition or our SWIFT definition of interoperability is indeed the standard. You're very right. but also not necessarily the standard. We want to also make sure that the data elements from the standard, and if some transactions don't contain all the data elements, at least make sure that the data elements, that they're somewhere in the transaction or exchanged with everybody. So even if it would start an ISO and in the meantime, over the transaction, it gets lost, that we make sure that everybody still has access to that data. And that data, I think, is mainly important from the compliance perspective. Secondly, I very much support what Rajiv said on interoperability is also between technology. The question on DLT, I think a technology which is a bit forgotten in this discussion is API technology, which can really, I believe, help on also making certain requirements faster, whether it's screening, checking on reference data or AML, or so that kind of technology, whether we talk about CBDC. At Swift, we look at interoperability more from how can we hook up all these different systems to communicate with each other in case something starts on a DLT. Because when you have a transaction there, it needs to settle in an RTGS, which generally is not DLT already enabled. So how do we make sure it ends up in an RTGS system? Or going to a CBDC, if it's only interoperability between CBDC, we're limiting the consumer's choice. He wants potentially to have it on his bank account, so we'll have to go back to the local ACH. So we're looking at interoperability more at making all those systems through our platform that actually keeps the data elements there and allows all these systems to communicate with each other. And we do a lot of proof of concepts there to demonstrate that that could work. That's one thing. I also wanted to come back to the thing mentioned by Phantom. Yes, of course, Swift, and like I think Rajiv mentioned, Visa, we have about no downtime. Swift is, we guarantee operational excellence and hence almost 100% being there all the time. That is not the issue. We can transport transactions at any time of the day. The question is more, how do you get finality of that transaction? And for finality, you need central bank money. And for that, we don't have always RTGS systems, ACH systems domestically open 24/7. So it's not always, in some cases there is, in some cases there's a variation in time. And if a transaction travels across the world, you might end up into an ACH or an RTGS system to get finality of the transaction at the moment that market infrastructure is not open. That is the same, by the way, for some.
The whole system is as good as the end destination, and if that's not good, the whole system might not be.
For a part, that is indeed what we see, whether it's the commercial bank being open and ready to function 24/7, and whether it's the market infrastructure ready to guarantee finality, because in the end, that is what is required to make sure that we get the risk out of the system. Is we need finality, we need central bank money at the end of that transaction. And on the other hand, we do need the commercial bank money to keep the economy going.
Well, we'll come on to Josh's very interesting experiment in that regard in a moment. That's worth talking about. Andrea, you have your hand up. Just want to give you a chance to come in before I move on.
Yeah, sure. So in terms of whether the DLT can help regulatory implementation, probably yes, to at least some extent, if you have the right type of DLT platforms. For example, we know all about smart contracts and what can be done with smart contracts. In Algorand, for example, we have some tools called Algorand Standard Assets that allow some certain function to be incorporated directly into the generation of the tokens. And so I don't know, for example, think about anti-money laundering processes. This can be easily implemented through functionally performing, highly performing smart contracts, of course. And for this type of thing, you need obviously the right type of decentralization. It's not enough to have just some decentralization doesn't solve anything if the technology underneath the decentralization is effective. In terms of interoperability, I completely agree with what Saskia was talking about. It's a matter of obviously have more focus on DLT talking to another DLT, sure, blockchain talking to blockchain, but that's not going to be the solution to all the problems that we are discussing. The main concern when we talk about the interoperability in blockchain space is like being able to integrate like a traditional, or some people refer to this as legacy payment system, into these new payment rails. It's difficult, yes, it's not impossible at all. Like there are like a few ways to do it, and APIs obviously is one of the main sources for this.
Just in simplistic terms, Andre, do you think DLT or DLTs could accommodate, say, 100 different regulatory systems to transact between?
Yes, like in the sense that like it's a big matter. The big issue there is like language translation, as we already mentioned, and so like it's not a problem of DLT accommodating those, but it's the problem of like different languages being translated into something that like is easy to interface from one system to another. And so like it's not we have something some technology based on like the so-called like short certificates representation of like a chain certificate representation of blockchain, for example, that allows you to simply and in a very compact way to represent like the state of different blockchain and be like a interchange and interface like from one DLT to another based on like a algorithm, like a proof of concept and like a technology on this point. And this, for example, will solve, once you have the right translation to the common language, will solve like this type of issue.
Okay, all right, thank you, Andre. A quick fire question from the audience, and then we'll move on to CBDC. Do any of the panel member organizations offer real-time cross-border payment, say in 10 minutes without human intervention? So put your digital hand up or your actual hand up if that is true of your organization.
The BIS customers are only central banks.
Yes. Fair enough.
John, I had to put the hand up just to say that I'm new to JP, so I can't comment on that.
Fair enough. Yeah, I think you may be able to. So actually, there are more yeses perhaps than the audience would have expected based on the question. But I think onto CBDC. So the payments revolution we've been talking about, or evolution we've been talking about. And the audience was nearly roughly split on which of those is preferable, as you saw. We'll ask again. Often involves discussions about CBDC. We have heard the argument that CBDC already exists at a wholesale level in the form of RTGS. Discussions about retail CBDC are incredibly complicated for a variety of reasons. It gets more complicated the closer you look at it, I'm afraid. But we won't go into that just yet. But I want to put a specific question from G&D. Wolfram Zeiderman, who's CEO there, has a question. G&D is an interesting entity in this domain. They provide banknotes originally, but now also a wide array of payment technologies. We worked with them recently on a survey into consumer attitudes to new digital forms of payment, including CBDC in Germany, Indonesia, Nigeria, and the US. So do check that out on the ONFEF website. It's a very interesting, different attitude between developed and developing markets, which may be an opportunity for developing markets, as you'll see. Dr. Zeiderman asked this. I think this is a good way to get into CBDC. Project Jura demonstrated how wholesale CBDC can optimize cross-currency and cross-border settlements, a critical aspect for international transactions. Which additional obstacles do you anticipate, if any, with cross-border transactions with retail CBDC, and how can they be minimized? This is a relatively simple question, but the answers are quite complicated in my experience. So I'm going to start with you, Henry, because you convene the institutions who'd have to issue this version of money. So over to you, Henry, first.
Yes, and permit me a plug. Project Jura is fantastic, and you should all read it. There's even a little video if you don't care to. So yes, I mean wholesale is complicated when it comes to cross-border, and Project Jura sort of does a good job showing that it can be done, and also cross-border not just with money but with securities. Although we're not supposed to call them that. It was a sort of a digital tokenized asset or something. It's basically a French commercial paper. But then what's the difference between that and retail? There's a lot more volume for a start. So you need chunkier systems. But what you But what you don't necessarily need is you don't necessarily need the speed. So can I sort of move money immediately? Well, yes, but do I want to if it costs me more money? I think the sort of a lot of the, like the thing that we were referring to earlier, the opportunities for netting retail transactions, they're much greater when it comes to retail payments, because either the speed doesn't matter quite so much, or the sort of the organizations doing the transfer can sort of take a little bit of credit risk in the way that they used to in traditional faster payment systems. So there's complications and opportunities, but really the big one sort of goes back to KYC and AML, and the sort of and the legal obstacles, and I think that's what this constantly comes back to. There's lots and lots of exciting opportunities offered by technology, but they still have to fit the existing legal framework, and that involves a lot of costs, which is why we need a lot of innovation in that space as well. But nonetheless, as we heard in the previous discussions, there's lots and lots of opportunities from automation that can make a lot of these retail payments a lot cheaper. A big issue today is sort of what Saskia mentioned about sort of data elements, where you don't have a data element, the automation fails, therefore you add costs, therefore you get sort of rejections and things like that. There's a huge amount that can be explored in this space. None of that has got anything to do with CBDC. It's all just the underlying technology. The fact that it's a central bank digital currency or a stable coin or anything else makes really no difference at all.
Good. All right. Well, thank you for that, Henry. Josh, you've conducted at JP Morgan quite an interesting experiment with MAS Banque de France on cross-border CBDC, and you're pretty open in the related paper about the benefits, but also the things that remain to be solved for. Do you want to talk us very briefly through that? So I think it's as good an answer as any to the question.
Absolutely, John. Just to clarify, it was not the JPM coin. It was we provide the technology. We're very privileged to be part of this experiment with Banque de France and Monetary Authority of Singapore. And the idea was to look at CBDCs, but more specifically wholesale CBDCs, and to see if it can solve the cross-border payments issues, many of which we touched upon today. So. And in terms of the interoperability, it was a very interesting point Henry and others raised. And I think for us, ultimately, it's moving value on ledgers. And that's what, for us, what matters. And especially with cross-border payments, with the correspondent banking, there's a lot of payment chains and issues in terms of mistakes and other things can happen. So and so CBDC provides this new model, where the M0 model, where when you have this central bank to central bank bridge, what they call the CBDC bridges, which we looked at between the euro as well as the Singapore dollars, can we simplify, cut a lot of those frictions? And so what we participated in was a simulation, basically, to look at this. So our first question was, can we use CBDCs as a commercial bank and facilitate a cross-border payment? And the answer was yes. And the second thing we looked at was, can we take out settlement risks? And in terms of the regions that we looked at, so for example, CLS already covers 18 different currencies, and adding a new currency to it is a process. While, for example, in the ASEAN region, there are a lot of currencies which are not necessarily part of this, and the settlement risk is just increasing. So we explored this corridor network and to see if we can execute a PPP and FX and cut out the settlement risks. And finally, the third thing we looked at in the experiment was sort of taking inspiration from the Revolution side, which is explore the DeFi models, for example, protocols like Uniswap, and instead of using crypto, can we use CBDCs and use automated market making methods, and how would that impact the FX processes or any OTC models? So these are the three we're looking at. So ultimately, it's looking at reducing fees, can we increase efficiency, and more importantly, optimize liquidity and not have it fragment.
Okay, thanks, Josh. I'd like to revisit actually the question of why. So this comes up quite often in our sessions. There's a very good review of the current state of affairs with CBDC in our report. So do check out the first couple of chapters. We describe their logic. But I just want to explore the first principles. It is already possible. For example, JP Morgan can move money relatively easy from Arkansas to London or wherever with relative ease already. What is the fundamental case for cross-border wholesale CBDC when money can already move around the world from jurisdiction to jurisdiction, albeit sometimes a little expensively? What's the reason to add this new form of public money, if that's what we're going to do? Perhaps over to you, Henry, on that first, and then to others who want to comment on it.
Well, so I take Josh's point about so CLS. So CLS is amazing, but it only covers a certain amount of currencies, and so if you want to do PVP, you have to kind of get lucky. So in Hong Kong they run a PVP system. That's very successful, but there are still some currencies where you don't get that sort of payment versus payment. So if I pay someone and they go bust before they've paid me, I lose a lot of money, which honestly isn't that big a deal. Actually, the big deal is the fact that everybody realizes at that moment that they could not be paid, and then nobody pays any money, and the entire payment system freezes. That is the financial stability issue. It's bigger than that one loss. So there's the potential to implement new infrastructure with central bank digital currency, and in the wholesale space, it does matter. It matters what kind of money you've got. So Saskia made this point earlier. You need central bank money in systemically important markets. And in systemically important FX markets, as more and more sort of emerging market currencies get bigger and bigger and bigger, you need settlement protection. The same principles apply as to retail. Choice and competition, it helps drive everything forward. So yes, we have good infrastructure, and you're quite right. As JP Morgan, you can do any of this sort of stuff. It's trivial. But nonetheless, it helps drive competition in those places where potentially there could be more new entrants, there could be more innovation. And that's why central banks are doing it. It's a kind of a foundational layer. They're giving safe money, and they're trying to sort of offer it in such a way that you can drive new efficiencies.
Is it a little bit like the example I gave right at the beginning? Knowing it's there is important. So knowing that deposit insurance is there is important, even though it's hardly used. Is it a matter of that, would you say, Henry?
Yeah, it is. I mean, so this is the wonderful thing about CLS and the sort of, there's a success story. During the financial crisis, when Lehman went bust, the FX market still functioned. If people thought that their counterparty was going to fail, then they wouldn't trade, they wouldn't pay. But because they had safe infrastructure settled with safe central bank money, those markets functioned. And they did so during a crisis, and that's the sort of that's the kind of the central bank driving motivation when it comes to this space.
Got it. Saskia, you were I'll come to Phantom House. Saskia, would you like to comment? You're a very important part of this infrastructure. How important is state-backed money in the wholesale cross-border scene?
Yeah, well, it's as I mentioned earlier, and as Henry clearly mentioned, it is important. But it is also only about 20% of what the global economy, the global trade needs. So a world existing only out of CBDCs, I think, would be quite difficult. The role of the bank is not to transport money, is actually to help everybody to trade and to enable the global economy and the global trade. So you do need a mix of both. You need a mix of commercial banks that offer commercial money, but that also offer additional services, loans and guarantees and, everything else. And you need potentially in some markets, maybe a CBDC-like system to guarantee settlements. If not all central banks open up 24/7, there are RTGS systems, maybe then in some cases we could use CBDC. And that is, I think, where, we from a SWIFT perspective look at, this is all good. This is all great, whether it's DLT-based CBDCs or CBDCs not, which also exists, CBDCs that are not DLT-based, or it's commercial bank money exchange through messaging or through APIs. We don't really care. We just want to make sure that they all indeed are interoperable so that actually, to Henry's point, the consumer gets a choice and that the banks involved or the players involved, the PSPs and the banks, everybody involved can use his system to the best interest in order to speed up, to lower the cost, to offer the best solution to that consumer or that corporate which is involved. So that's a bit, I think, more my thinking than just going for only CBDC.
Okay, Phantom, you wanted to comment as well?
Yes, I'd like to comment on the two cost factors in the cross-border payment. One is the last mile. Final cash out cost is one of the highest. And then another one is the currency exchange. So if people in one country try to send the money to another country, they have to convert to the dollar and then dollar to another country. This kind of currency conversion. And I'd like to mention two unique approach. They solve this, the technical way. And we're talking about interoperability, and one of the most important interoperability infrastructure that we need to build is a universal addressing system. And when designing the CBDC, we like to have universal addressing system that is comparable all around the world, so that anyone in any country can send the money to somewhere else. And we in our Metamui system, we use a self-sovereign identity system. That is, so we make identity as an address. So if you know the identity, then you can send money back and forth. And for this cross-border wholesale payment, one of the technical and the other business approach is that we would like to enable direct one currency to currency exchange without using the settlement coin. And to implement this, it requires one other technical innovation called the meta blockchain. That means when you publish the token and CBDC, we still need to do the programming, like smart contract, etc. But meta blockchain, we can dynamically create the currency without requiring the programming. This requires, fractional reserve banking model to implement the currency multiplication, but also it can be used for cross-border internet payment system and solve the compatibility issues. So let's say that we have two different countries has two different CBDC, then it'll take a lot of time to integrate two different systems one by one. And even the standardization process is very slow and things like that. But if you have this dynamic creation system, meta blockchain, that means a country CBDC, whether it doesn't really have to be CBDC, just a paper currency, and dynamically create meta dollar, and then dynamically meta euro, and then we can in Metamui system we have a inter-blockchain atomic swap protocol possible. So that means two meta coin can dynamically swap each other.
And actually, Josh's the experiment that Josh is involved is a little bit like that. Brings us into the wonderful world of tokenization, and do look up the chapter on that we have in the report we're launching today. Andrea, you had your hand up. Please, over to you. Then I've got some questions about back to regulation, which and then cybersecurity, which we need to talk about as well.
Yeah, I like what Phantom is talking about, and I would like just to add a little thing about what the also CBDC, maybe DLT base can do, in particular in some region of specific region of the globe. If you think of, for example, the European Union, the European Economic Area, a CBDC wholesale DLT based CBDC there for that area where 20, 25 countries have to operate cross payments at state level, across states. They're like a solution that like unify under one infrastructure. That system, it's, I think, clearly like more advantages than like having like a non-DLT based system, for example. I understand that like once we started talking about like different parts of the world, connecting the US to the European market, for example, other issue, and Saskia talked about this very, very clearly in terms of interoperability and last mile and all these kind of things matter. But like in a more integrated region of the world, but we have many examples there. We have like a common economic area in Latin America, in Africa. This area where like a unified system, blockchain based and like DLT based, like a CBDC wholesale, could actually already solve like the majority of the issue that we are talking about today.
We haven't talked much about stable coins. I mean, one of the answers to this, of course, is a currency created by, let's say, Facebook. There could be other people, but let's say Facebook creates a version of money, and it might not just be comprised of dollars, although they were told not to do this, as we know. But let's say they were able to do it. That would potentially solve a lot of these problems all in one go. So you would get rid of currency issues, and maybe they can solve the KYC stuff. I know that's pretty radical, and regulators really don't want it. But what do we think about that, Henry? Then I want to come back to Rajiv and ask about licensed financial institutions and AML and so on. So, Henry, over to you.
Yeah, it's utterly pernicious. It's it's funny, but so by kind of avoiding the problem, so an inherent problem of cross-border payments is currency. There are costs and there are risks involved. How do you drive those down? Well, you make them transparent. So, you know, back to your example of the purchase of the coffee. Do you see the charges that MasterCard in that case leveled at the retailer for the FX? Probably not. You see a little bit subsequently the month after, and you think, oh, that was painful, but it's too late by then, and it's worth it for the convenience. But when it comes to sort of industrializing that through either some sort of currency substitution, so one big system where you don't make your remittances, for example, in the currency of the receiver, you just give them US dollars or euros or whatever, or some currency that you've created, then you just pass all that risk to that other person. You don't get rid of the problem. You just pass it back on to somebody who then has to manage it or can't manage it. So it doesn't solve the problem. It just moves it. It's not a good outcome. It's not success.
Okay, thank you. Rajiv, we've heard from innovators here. Your organization is part of the existing infrastructure. We've heard that that's not just technology. There's a complicated element of regulation embedded into what's going on, including which has its own cost, which we need to remember. Somebody in the audience asked, are licensed financial institutions still the best entities to control AML? In this case, terrorist finance, they've asked about as well. And this came up when we did this last year. The argument from the bank that we had last year was essentially that their principal reason to be in this discussion was regulation and not technology or systems. What do you think about that, Rajiv? Obviously, you have to do that all the time as well.
Yeah, no, of course, all these issues are important, and our point on licensing bit in particular was that for any global organization to offer money movement across borders requires operating between various countries and geographies, and the licensing requirements can be very different in different markets, and that can add a layer of complexity and cost for these companies who want to operate across borders, and that is a significant barrier in time to bring those innovations to a wider market. And that was the point we're trying to make, that if in an ideal world that licensing process got simplified, some kind of a passporting of sorts, it could definitely make innovations come quicker and allow more companies to do a more money movement on a broader global scale. There is a significant cost and effort in being able to operate in different countries, which is needed for most global players.
Okay, thank you. Would you expect, Henry, I mentioned stable coins, so alongside organizations like Rajiv's and Josh's, of course, Saskia's, that already perform an important role moving money around the world. The idea has come up in our sessions that you could perhaps add stable coins regulated a bit like banks. Perhaps you regulate them as narrow banks and add them to these existing incumbents in the payments infrastructure. What do you think about that?
Yeah, I think there's definitely a role. So as you say, depending on how you pull these things together, they could look like narrow banks. They could look like some sort of infrastructure that sort of, as some proposals are put together, they're sort of, it's a system, but it's just basically a series of accounts at central banks structured in a certain way. I think I'm sorry, I keep banging the same drum. I think it's really positive because it adds another choice. It adds another means through which companies can transfer money, and potentially, and to Saskia's point, maybe this won't be as efficient. If you have a narrow bank, then it can't offer credit. It's safer potentially than a normal commercial bank, but then it's just not as efficient. And certainly we wouldn't want we wouldn't want the economy to look like that. We wouldn't want to starve it of credit. But for some people who care more about the safety of their funds, and maybe in some way they can use distributed ledger technology and do something amazing and innovative, it's great. More diversity is better in this space.
Okay, thank you. We certainly know that the central banks that we talk to are wary of disrupting the existing infrastructure too much, particularly, as you say, if you disrupt commercial banks too much and shrink them, you'll shrink the economy via the fractional reserve banking going into reverse. So then others say that if they're regulated like banks, stable coins, then that will put off the interlopers as well. So it's a very complicated discussion about that.
Yeah, well, I mean, so you have the potential for, say, a stable coin issued by, say, one of the big techs. So you have a massive network, and then you have what is effectively an enormous money market fund. Well, under current regulations, money market funds are quite scary things. Especially when everybody rushes to the exit. There are financial stability risks. There are sort of issues, considerations that need to be thought through if these things get massive. But with the proviso that it's done safely and also transparently. I think that's a big issue that we see with stable coins, is that people, it's a bit like back in the crisis when you say, what is actually underneath your asset-backed security? What are those assets? What are the assets underneath your stable coin? A lot of people have no clue. And there's an enormous amount of concentration risk across different stable coins. With the proviso that is sort of safely dealt with, there's the potential for a lot of efficiency benefits for the whole system.
I'll sort of do a very quick fire questions. So just put your hand up if you agree with this, and not if you don't, because we could spend 90 minutes talking about it on its own. Is global digital identity needed for everyone in order to address KYC? An amazingly bold question. Put your hand up if you agree with that. Not too sure. Okay, that's that would chime actually with what we get from our surveys. There's a huge wariness we find on identity management. I want to spend a little bit of time, so we haven't got much time left. We've got an important chapter in this report by Simon Brady on essentially cybersecurity and regulation. The existing infrastructure, as he describes it as well, a lot of it is 20 years old or more. Central banks I know are worried as well about DLT. The People's Bank of China chose not to use DLT for their CBDC experiment. They may or may not add a DLT later, as technologists are solving the problems. let me know what you think about whether innovation is going to bring more cyber risk or get rid of it. I know that's a very simple question, but we haven't got long. So, what, yes or no? What would you say, Saskia?
It's a very difficult one, but I think if everybody adheres to some of the rules, like I think some of the central banks, the overseers, SWIFT is overseeing. We've been working with the overseas central banks on a plan. I think if everybody adheres to the plan, it's probably not the question about when, but at least to try and delay any cyber attacks. Will there be some cyber? I think it's inevitable somehow, but we need to try and protect as much as possible. So putting it on one single system is probably dangerous. So hence, I think the fact that we're talking here about interoperability, different systems, is probably a good way to protect and use, like, that's why sometimes I know that SWIFT is not seen as the biggest innovator, but it's also because we have to do it very responsible. Because if you transport, the world's economy transactions, you need to do carefully. So that is one of the elements we really take into consideration when we do innovation, is make sure operational excellence, but also cyber, which is a very important element, especially these days.
Okay, well, I'm going to come back to the evolution versus revolution question in just a minute on that basis. Rajiv, what do you think? Is technology going to make itself more safe, or is it going to increase the risks, do you think?
I think it depends on whether these issues which Saskia and I have been talking about again and again around operational resilience and cybersecurity have to be thought at an early stages than later. And that's almost like a non-negotiable part of any payment system. And one has to pay adequate attention to it. And I agree with Saskia around the point on single points of failures as well. Hence, this point around multiple systems should exist. And there should be a way to avoid the single points of failures.
Do you think, Rajiv, the complexity of the current system is actually partly defending it?
I'm thinking about that question.
Okay, well, you're welcome to come back to it. I know it's a strange question. Yeah. I just wonder if it's the Byzantine nature of the system is a curious defense.
No, I think you need to think about it at two levels. So one is, you have a payment system which does what it says, like your experience buying Starbucks. You didn't have to even think about what happened.
Yeah.
And there's a lot which goes behind that to happen. Exactly. So that's an important part of it. And two is the open access nature of the payment system is a very important aspect. So for companies like Visa, there are very clear rules for anyone who wants to participate, right? And those rules are set very clearly, and there's an open access and it's an open system. So you have like hundreds and thousands and millions of merchants and issuers and stuff who participate. So it's a very open system, but with very strong foundations in cybersecurity and resilience. And I think that's how any good new payment system should look like, is have a strong foundation, but have a very robust open access and very transparent way of joining.
Okay, thanks, Rajiv. Henry, you've got your hand up. Very briefly to you, and then Phantom afterwards.
Well, so one follow-up to that. So I think cybersecurity is great. You lock down the payment system, but one thing that actually SWIFT has been working on for a while is endpoint security. So that's what if your customers get hacked, and then they start very legitimately sending their own money away. The difficulty of doing that today is the only way to really steal money is to send it cross-border. So the example I'm thinking of is Bangladesh Bank. So Bangladesh Bank got hacked internally, asked its correspondent, the New York Fed, to send its money that eventually made its way to Filipino casinos, where it disappeared. You need to find somewhere to disappear the money. As payments, cross-border payments, get better, get faster, that can happen very, very quickly, and then the money can disappear very, very quickly. So it might be that cyber risk, it gets more difficult to attack the main system, but those endpoints, if all the users of these very open systems don't lock themselves down properly, they will find that their money disappears very, very quickly, and I can imagine that happening far more frequently.
That's a very intriguing point. Thanks, Henry. Just while I'm about to hand to Phantom, but please could you all just Sasha, if you put up the poll again, I want to see whether attitudes to evolution versus revolution have changed as we've looked at the pros and cons of both. So perhaps you could just vote again in that poll for me, please, those of you listening in, and we'll have a look again at the result. But over to you, Phantom, please. So put the case for a revolutionary system being more secure.
Yeah, of course. I mean, good implementation. To do that, I'd like to very shortly about two technologies that we need to involve. One is, Sasha mentioned about the data, but we also need to trust the source of the data and then proof of the data coming from the certain identity of the system. To do that, we need a decentralized public key infrastructure. And then this can be implemented part of the identity blockchain. And if you have this identity blockchain, then we can trust the source of the network. And also we can implement the ownership binding to the identity of the user, not to the private key. So in the Bitcoin and cryptocurrency, if you lost the private key, you lost all your assets. This kind of system cannot be implemented in a CBDC system. But if you have an identity-based system and decentralized public infrastructure, then you can bind ownership to the identity of the user. When the user lost the private key, we can simply reset the private key.
Okay, fantastic. Quickly over to you, Andreas. You're a proponent of a revolutionary change, or your organisation is of a revolutionary change. Do you think that the new architecture will be safer than the one it's seeking to replace?
What I can say is that, like, for sure is not adding risks that are not already in place now in the current system. So like for what concern like the DLT part, like it's this level of cybersecurity, there are no concerns that like go beyond bigger than what we already know in terms of like a system, because as we said, the problem is not in the transaction per se, often is on like another like a weak point spots in the system, like and endpoints in particular. And cybersecurity and blockchain like can some type of blockchain can of course introduce like a risk that are like difficult to control. Like it's not anymore the case for like some type of technology like Algorand, I would say. So no higher risk.
Okay, thank you. So we very slightly changed minds, but not much. I've just got the result through from KTN. I'll give you that result in just a minute. But I just want to thank you all again for your time. We could have spent 90 minutes on each of the questions. The cyber one in particular is very complicated. There's lots more in the report. There's a whole question about technology and regulation meeting one another in the middle as well. So do please take a look at that. Thanks again to the organizations who supported the report, SWIFT, Visa, G&D, JP Morgan, Onyx, Algorand, and MetaMui. Thank you very much for supporting that. Do download the report. We will be doing it again next year. We'll shortly be also reviewing the World CBDC plans in a publication we're putting out in January. We managed not to only talk about CBDC, so I think we could congratulate ourselves for that. Thank you for your wonderful contributions. The poll results are in. So first poll, we had 54% in favor of revolution, 46 evolution. Second poll, 52% for revolution, 48 for evolution. So completely inconclusive, but that in itself is important and useful information. So, I'm told it's moving. Which direction is it moving in, KTN? 57% revolution. So, okay, we've got revolutionaries piling in at the last minute. We've made people more relaxed about the potential for wholesale change. So thank you very much, everyone, for listening in. We really appreciate it. Thank you for engaging with us, both official sector, private sector, incumbents and revolutionaries. We're very pleased to convene you here. Thank you very much for joining us today. Thank you all, and see you again soon. Goodbye.
Thank you.
Thank you very much.
Thank you.
Goodbye.
Bye.
Thank you all.